Hi everybody, and welcome back to video number 2 in chapter 20. When we left off, we were looking at the termination option, and here, with an illustration, Cabrera Company leases a building and land from Worldwide Leasing for 6 years with monthly payments of $10,000. The lease contract allows Cabrera to terminate the lease after 2 years for a total payment of $140,000. At the start of the lease, it is reasonably certain that Cabrera will not continue to lease beyond 2 years. What are Cabrera's lease payments? In this case, Cabrera should include the cost of the termination option in its calculation of the present value of its lease liability. The total lease payments, therefore, are $380,000. That's $10,000 per month for 2 years or 24 months, plus the $140,000. Okay. Discount rate. The lessee should compute the present value of the lease payments using the implicit interest rate. This rate at the commencement of the lease, which causes the aggregate present value of the lease payments and the unguaranteed residual value to be equal to the fair value of the leased asset. In the event that it is impractical to determine the implicit rate, the lessee will then use its incremental borrowing rate. Alternative use test. If at the end of the lease term, the lessor does not have an alternative use for the asset, the lessee classifies the lease as a finance lease. The assumption is that the lessee uses all the benefits from the leased asset, and therefore the lessee has essentially purchased the asset. Let's take a look at an illustration of that alternative use test. We assume that the Hale Construction equipment manufacturer builds and leases hydraulic lifts to meet unique loading dock configurations of Amazon, the lessee. Does the lease arrangement between Hale and Amazon meet alternative use tests? Explain why or why not. Well, given the specialty nature of the equipment, only Amazon can use the lifts. Because Amazon receives substantially all of the benefits of the leased asset, the lease meets the alternative use test. Okay, we'll put this into practice with lease calculations here. Here, Morgan Bakeries is involved in 3 lease situations. Each of these leases is non-cancelable, and in no case does Morgan receive title to the properties leased during or at the end of the lease term. All leases start on January 1, 2025. With the first rental due at the beginning of the year. For each lease, assume that the lessors have an alternative use for the assets at the end of the lease, unless ownership transfers to the lessee. Additional information is shown in the following table, where FV is fair value and RV is residual value and PV is present value. So here, for example, here's our type of properties. We have cabinets, trucks, and computers. And our yearly rentals are shown. The lease term in years is shown. The estimated economic life is shown next. Purchase option, renewal option, fair value at commencement, residual value guaranteed, residual value unguaranteed, present value of payments, 1, using the incremental borrowing rate of 8%, and 2, using the implicit rate. and finally, the fair value at the end of the lease. So for each lease arrangement, determine the correct classification for the lease for Morgan, the lessee. So let's look at Harmon first. Here we're leasing cabinets, and so in analysis of the Harmon Incorporated lease, is there transfer of title? No. Number two, is there a bargain purchase option? No. Number three, the economic life test. The lease term is 20 years, and the economic estimated life is 30 years. Thus, it does not meet the 75% test. Okay, so now we'll take a look at the present value test. The present value test, that's the 90% test. No, the present value of the rental payments, which are $63,621,600, is less than 90% of the fair value of the underlying asset as shown below. So here's the fair value, $75,000. We take 90% of that, that's $67,500. But as we just shown, $6,000 times the present value of an annuity due for 20 years at 8%, we have a rate of 10.60360, and that results in a present value of rental payments of $63,621.60. Okay, none of the lease classification tests are met, so both Morgan and Harmon should account for this lease as an operating lease. Okay, so let's go back to the Mendota Truck Company, and here we're talking about a truck, lease term of 3 years, economic life of 4 years, etc. So now, if we analyze that lease, is there a transfer of title? Number one, no. Two, is there a bargain purchase option? No. Number three, the economic life test, 75%. The lease term is 3 years, and the estimated economic life is 4 years. Therefore, it does meet the 75% test, 3 divided by 4, 75%. And number four, the present value test. Here, the fair value was $20,000. We take 90% of that, and that's going to give us $18,000. We get that $20,000, by the way. Here's the fair value at commencement, $20,000. And then the rental payments were $5,189.31, and the present value of an annuity due for 3 years at 8% is that factor is 2.78326, and that gives me the present value of the rental payments of $14,443.19. Okay, so the present value test is not 90% either. So as we look at the present value of the rental payments here and the present value of the guaranteed residual value here, that takes us back to the present value of the lease payment of $20,000. So in terms of this, in terms of this lease, it meets 2 of the lease classification tests. The lease term is 75% of the economic life of the leased asset, and the present value of the lease payments are greater than 90% of the fair value of the lease. Morgan and Mendota would account for this lease as a financing lease. A few things to note. One, They did not incorporate the rent renewal clause into the lease term, leaving the lease term at the original 3 years. That was because the option was for a standard renewal, and this would not be considered a bargain renewal. And they did not incorporate the guaranteed residual value when completing the 90% fair value test, because Morgan guarantees a $7,000 residual payment. Okay. Now, if we go back to the Appleland here we're doing a computer, lease term of 3 years, etc. So now, if we look at Appleland, was there a transfer of title? No. Number 2, was there a bargain purchase option? Yes. The $100 purchase option is clearly a bargain when compared with the $3,000 estimated fair value at the end of the lease term. So Morgan would be reasonably certain to exercise the option. Number 3, the economic life test, the 75% test. The lease term is 3 years and no bargain renewal period exists as it is simply a standard renewal clause, which is not reasonably certain to be exercised. Therefore, the 75% test is not met. 3 divided by 5 is 60%. And then number 4, the recovery of the investment test. Here the fair value was $10,000. We take 90% of that. That gives us $9,000. Whereas the rental payments were $2,640.35, and the present value annuity factor for 3 years at 6% is 2.83339. And that comes out to $7,481.14. So the bargain purchase option is, we'll use that present value of a dollar factor for 3 years at 6%, and that's 8.83962, or $83.96. So we add those two beauties together, and we get the present value of lease payments using the implicit borrowing rate of $7,565.10. The present value of the payments, therefore, which is lower than 90% of the fair value. The lease does not meet the present value test. The lease meets the bargain purchase option test such that Morgan and Appleland will account for the lease as a finance lease. The $100 purchase option is clearly a bargain when compared to $3,000 estimated fair value at the end of the lease term. So Morgan would be reasonably certain to exercise that option. Morgan was aware of the lessor's implicit rate used in determining the lease payments of 6%. So instead of using the incremental borrowing rate, Morgan will use the 6% rate for the present value test. Note that the present value of the lease payments includes the purchase payment as it is a bargain. Okay, now we'll take a look at explaining the accounting for financing or finance leases. Here's an illustration. I think we will stop the video at this time, and when we return, we'll take a look at this illustration, assuming coffee and beans equipment and Starbucks. Until that time, bye for now.